Hello, welcome to this week's Financial Friday, which is all about investment properties. So when you're looking to buy an investment property, there is a couple things that you need to know that you should be prepared about ahead of time. So the first thing that I like to explain to people who are looking at investment properties is being prepared for the expenses, the costs that are associated with it. So you would think of all the normal utilities, and that would be negotiable depending on if the tenant pays it or you. But what people don't think about is that they still need to pay for the property taxes. And as a landlord, you still need to have your own insurance on it to cover the dwelling. So that's a really important factor that people don't think about, as well as your taxes. So when it comes to investment properties, this is taxed as passive income. Passive income gets a higher tax on it. So you need to be prepared. It's really great to speak with your tax advisor or an accountant about it, and just being prepared and making sure that the costs cover themselves. Now, when it comes to buying an investment property, something that you may not know is that you actually need 20% down. This can be from your RRSPs or many other ways that you can get this 20% down, even by saving. But if you are buying a property, and there is one caveat, but if you're buying an investment property, you need to have that 20% down. Now, the caveat is if you are buying a home that you do not have another insured property by CMHC or Sagen where you've only put 5% down, you could actually buy a home for 5% down if you are also going to live in it. So if you bought something that perhaps had a basement suite, or maybe a multi-unit, up to 4 units, I believe, you can live in one of those units, buy the property for 5% down, and you could actually, that's kind of the way to get around the system of having to have 20% down. And then you can still collect rent from the other tenants, and a lot of times that will actually pay the mortgage that you have on there. So that's one of my favorite tips. Another way that you could come up with the 20% down if you didn't go that route was pulling equity out of your existing home. When you have a home and you pay down that equity every year, you can actually refinance it and refinance up to 80% of the value of the home, and you can use some of that to help you with your down payment or your closing costs or whatever that may be. Now, some tricks that some landlords use are to hire a property management company, and that property management company could be an extra expense as well. So with that, typically they go anywhere from 8 to 15% of the rent, depending on how often they're having to find new tenants and what work they have to take care of. So if they're dealing with snow removal, if you're dealing with snow removal or lawn care or whatever that may be, then your expenses would be higher on that too. Now, when it comes to qualifying for an investment property, banks, it really depends on what bank you're using. Some banks can actually only use 50% of the incoming rent or expected incoming rent to go towards qualifying. And other banks I've seen use up to 80%. And the reason for this is they do expect that at some points it will be vacant, and they want to make sure that you can cover those costs on your own. So that's just another factor to consider. And then we also have capital gains tax. So this is a property that, an investment property, if you're not actively living in it, you would have capital gains taxes on it when you do eventually go to sell. So another consideration. Now, the other things to think about is what are the purpose. So is it going to be a long-term rental or a short-term rental? A long-term rental is really great. You get your tenant in there, and if you have them sign a lease, you'd have a tenant for certain for 6 to 12 months. some people are looking at investment properties for short-term rentals. So this would be Airbnb. Now, considerations on this would be, Swift Current, I think, is pretty good for allowing these, but there is a lot of places that do have restrictions or do not allow them at all. And so that's something that you would want to look into, is if a short-term rental is allowed, and whether your home insurance will actually cover that type of rental as well. Finn, come here. And otherwise, the other consideration that I would have you think about is, when you are looking, if you have never had an investment property before, I think it's really important to find someone that has. So someone that has experience, whether it's a friend or a family member or even a real estate agent that has experience dealing with rentals, dealing with tenants, and people who can help guide you in the right direction so that you don't end up having unforeseen issues, or maybe buying a property that you can't rent out or that is extremely hard to rent out. So I think it's important to have that guidance and kind of build that team of people who can help support you. So that's it for today. Next week, we are going to dive into life insurance. Not specifics on life insurance, but whether you should be going through your bank for life insurance or whether you should be getting your own private insurance. So thank you for joining me on this week's Financial Friday, and I hope to see you next week.